Join TWR in 2023. What is up, team? Chuck with Traders War Room, and I'm back at you with another video. Today's tech video, we're going to go over the intrinsic versus extrinsic value, why this is important, why it matters, and how to understand your trades. I get a lot of questions all the time about what my trade is worth and why it's worth something based off of different variables and factors. And this video is going to give you a little understanding on why intrinsic value versus extrinsic value is important and what it does to our trades based off of different factors and variables that go along the life cycle of the trade. But real quick, before we get into that, I want you to watch this promo about our upcoming class that we have on Sunday at 1 p.m. Central Standard Time. I hope to see all you guys in there. It's a fantastic class. Going to teach you how to control your emotions and manage your risk during trading, which is something that everybody needs. As always, if you're ready, follow me and let's go to war together. Traders War Room, baby. Let's get it right now. Plan your battles with Traders War Room classes. Join TWR on 5 February at 1 p.m. Central Standard Time and learn how to control your emotions and manage your risk. Listen, emotional trading is an account killer every single time. But managing your risk and planning your attack assists going from this to this. Calm, cool, and collected. So you can win at trading and gain consistent profitability. Join us on 5 February and learn how to manage your risk and control your emotions while you trade. Going from this to this. Register today at traderswarroom.com/upcoming classes or use the link in the description. I'll see you there. TWR Tech Video. So what are extrinsic and intrinsic value? Well, the definition, and I know it's boring, but it's essential to understand the intrinsic and extrinsic value represented in terms of option, is basically intrinsic means belonging to the essential nature of a thing. Extrinsic is not part of the essential nature operating from outside. So really, what do intrinsic and extrinsic values mean when it comes to option trading? Well, let's get into the history of intrinsic and extrinsic theory. So intrinsic value has traditionally been thought a lie to the heart of ethics, right? Philosophers use a number of terms to refer to such value. The intrinsic value of something is said to be the value that is a thing in itself or for its own sake or as such or in its own right. And extrinsic value is not intrinsic. And that's basically what philosophers understand when you go into the theory of these particular terms. Many philosophers take intrinsic value to be crucial to a variety of moral judgments that we would utilize basically to make a trade. For example, according to fundamental form of consequentialism, whether an action is morally right or wrong has exclusively to do with whether the consequences are intrinsically better than those of any other action one can perform under circumstances. Many other theories also hold that what is right or wrong to do at least has in part to do with the intrinsic value of the consequences of the actions one can perform. And in our case, intrinsic consequences are in dollars and cents. Moreover, it is commonly believed that one is morally responsible for doing in some function of the rightness or wrongness of what one does, then the intrinsic value would seem relevant to judgments about responsibility. Intrinsic value is also often taken to be pertinent to judgment about moral justice, whether having to do with moral rights or moral desert, insofar as to good that justice is done and to bad that justice is denied, in ways that appear intimately tied to intrinsic value, intimately. Finally, it is typical thought that judgments about moral virtue and vice also turn on questions of intrinsic value, inasmuch as virtues are good and vices are bad, again, in ways that appear closely connected to such value. Now, all four types of moral judgment have been subject of discussion since the dawn of the Western philosophy in ancient Greece. Now, understand this is where we're getting into the Greeks that are associated with derivatives, okay? This is why you probably were thinking, what do I need to know about this crap, right? This is all ancient philosophy terms on intrinsic and extrinsic. Well, it's all tied together because we utilize the Greeks in derivatives, and it's important to understand where the philosophy comes from so you get the mindset of why it's utilized. The Greeks themselves were especially concerned with questions about virtue and vice, and the concept of intrinsic value may be found at work in the writings and at writings of moral philosophers ever since. Despite this fact, and rather surprisingly, it is only within the last 100 years or so that the concept itself has been subject of sustained scrutiny, and even with the relative brief period of scrutiny, has waxed and waned. Right here's an example. This is a SPY trade, basically, and when we look at how we're looking for the trade, we're looking at kind of the substance, right? The meat and potatoes. We're looking at the Greeks because we want to see the probability or the judgment call that we're making to go against us or for us in our particular trade. And it gives us the ideas of how we're going to trade this and rationalize whether we should make this trade a good trade or whether we should accept that this trade is going to be a lotto or potentially a bad trade. All right, so now that we got all of that theory out of the way, what are extrinsic value and intrinsic value when we're talking about options? Well, options can be made up of intrinsic value, extrinsic value, or both. The intrinsic value of an option is a tangible value of the option at expiration. The value in the nature of the option. We need to understand all options are based off of the premium and meeting that premium strike price by the time it hits the expiration date. That is the whole basis for options. The extrinsic value of an option represents the external factors that can impact the intrinsic value, like time and volatility and external factors. The total value of an option can be broken down into two parts. A, intrinsic value plus extrinsic value equals total option value. Or phrased differently, A, the current value plus B, the time and volatility value equals C, the total option value. Now let's break down the equation and first look at how we define the intrinsic value. So intrinsic value is, when it comes to the options trading world, is how much an option would be worth if it expired right now. If all the time on the option suddenly disappeared and it was exercised, how much would you make, not including additional fees? If you would make nothing or $0, the option would have no intrinsic value. If you make money, the amount you would make would be the option's intrinsic value. An option should never be worth less than its intrinsic value. Now, if an option was ever being sold for less than its extrinsic value, experienced traders would buy the option and exercise it immediately for its intrinsic value. The profit would be equal to the difference between how much they paid for the option and the amount they get for exercising it, minus a commission fee. Remember, options, specifically American options, can be exercised at any time before they expire, and options are always worth a minimum of their intrinsic value because they can be exercised for their intrinsic value at any time. Now let's talk about how to calculate intrinsic value. So what does intrinsic value mean in different option types? Well, options only have intrinsic value if they are in the money. In the money is another way of saying an option has intrinsic value. In other words, intrinsic value tells you that if the option were exercised right now, it would be in the range that would return money, hence the term in the money. The amount of an option is in the money is the same amount that intrinsic value has on the option. All right, so let's talk about the intrinsic value for puts. Puts are in the money or have intrinsic value if their strike price is above the current stock price. A put gives you the right to sell stock at the put strike price. If the strike price is higher than the current stock price, you will be able to sell the stock for more than it's currently worth. Your total profit at expiration, no time left, is the intrinsic value, or the difference of the strike price and the option price. Strike price minus stock price equals option value at expiration and intrinsic value. If the option has no intrinsic value at expiration, or it's out of the money, it will expire worthless. Now in this example, we're finding the intrinsic value of a put. So let's say COS is trading at $166.24, and we sell a put at a strike price of $170. How could we find the intrinsic value from those bits of information? Well, we have to remember that intrinsic value equals strike price minus stock price. So, in this example, in using this equation, it would look like this. 170 minus 166.24 equals 376. That's our intrinsic value. If you own the 170 put and at expiration the stock was trading at 166.24, you would make 376 or 376 when you multiply that by 100, the number of shares of stock controlled by one option contract. Now we talked about puts, let's talk about calls. So calls are in the money, have intrinsic value if the strike price is below the current stock price. Remember that a call gives you the right to buy a stock at the call's strike price. In the picture, we can see how intrinsic value in red and extrinsic value in blue add together to form the option's total value. So if the strike price is below the current stock price, you will be able to buy stock for less than it's currently worth. Your total profit at expiration, no time left, is the intrinsic value, the difference between the stock price and the stock price and the strike price. Stock price minus strike price equals the option value at expiration and intrinsic value. Like puts, if a call option has no intrinsic value at expiration or it's out of the money, it will expire worthless. All right, so here's our example for the call side. For simplicity's sake, we're looking at the same ticker, COS, right? If COS is trading at 166.24 and we sell a call at a strike price of 160, then the intrinsic value would be $624 or $624. How did we get that number? Remember, stock price minus strike price equals intrinsic value. So 166.24 minus 160 equals 624. Multiply that by 100. That gives us our total. Now let's talk about intrinsic value. If intrinsic value is worth the option it's worth if it expired right now, if we took away all the time. So then what is the extrinsic value? The easiest way to think about extrinsic value is this. Extrinsic value is everything that is not intrinsic value. If we know an option's total value, which is the premium it's being bought or sold for, we can then calculate the extrinsic value by subtracting the intrinsic value from the total value. Whatever is left is the option's extrinsic value. As an equation, it looks like this. Total option premium minus the intrinsic value equals the extrinsic value. So, both intrinsic and extrinsic value are determined by the fill price and the bid and ask spread. In this example, the equations would be 765, the premium, minus 624, the intrinsic value, equals 141 extrinsic value. But that doesn't really help us understand where the extrinsic value comes from and why the option is worth more than it can be exercised for today. So why on earth would anyone pay more for an option than what it would be exercised for now, right? Let's explore this. Another way to understand extrinsic value is this. Investors pay more than an option's currently exercise value because there is value in the ability to hold a contract over time. The amount of time left until expiration and the volatility of the underlying directly impact the price of an option, thus impacting the extrinsic value. Investors buy options hoping the option's value will increase during the option's lifetime, or sell options and hope that the value will decrease. Options cost significantly less money than buying stock outright because options have expiration dates, while stocks do not. Because options have expiration date, the extrinsic value is defined as the additional time and volatility due to traders that they pay for. As stated before, traders are hoping that the options price will change in their favor. Essentially, the market is aware the price may change, so added premium or the extrinsic value is included to compensate for the changes in time, value, and volatility. Now, let's talk about time value or days to expiration. One aspect of extrinsic value is referred to as the option's time value or days to expiration. You guys also might know this as time decay or theta. The more time an option has until expiration, the more time the underlying price has to change. Thus, the more time the option has until expiration, the more valuable the option becomes. Now, this is where we get into implied volatility, and we will cover this in more detail in another tech video, but I just want to hit the basics of this as it does pertain to intrinsic and extrinsic value, especially in derivatives. So aside from the time value, implied volatility also makes up the extrinsic value of an option. Implied volatility effectively measures how much the stock price may swing over a specific time frame. Adding volatility to time value gives us the extrinsic value of an option. As time expires, an option's extrinsic value will move to zero, leaving only intrinsic value left. If volatility in an underlying decreases, the extrinsic value of the option will also decrease. If an option has a longer contract or higher implied volatility, the extrinsic value of the option will increase. You can see this in the options chain comparing options with the same strike price but longer or shorter time frames. Now, this is why you ask the question sometimes, why does my price of my option decrease even though it's moving in the same direction after, say, earnings? This is it right here, because the implied volatility is no longer there because the known factors are out there. And so even if the stock is pushed in your direction, the implied volatility is counting against your extrinsic value because you're probably outside of the money on your trade, and the intrinsic value is becoming less and less and less because of the factors of implied volatility and extrinsic value. That's why your contract is less, even if it's moving in your direction. All right, so let's go ahead and wrap this up. So intrinsic and extrinsic value recap. All options expire with only intrinsic value. Intrinsic value equals the strike price minus the stock price. Extrinsic value, basically time value and volatility, decreases as time decays or volatility decreases. Extrinsic value equals total option premium minus the intrinsic value. In the money options have intrinsic value. Out of the money options do not. Out of the money options are all extrinsic value, and that's why you'll see the fluctuations once intrinsic factors are known on the underlying. So I got a quiz here, and I want to see some comments in the comment section based off of this, and I'm curious on your guys' answers. So let's talk about it in the chat section on the social media platforms. But basically, I want you to test yourself on these option knowledge that you just learned and try answering these questions. So what is the intrinsic value of the following calls? First question, number one, $80 strike call with the stock at $100. Or two, $80 strike June 18th, the call is ABC or XYZ when XYZ is at $100. And three, $100 strike June 18th call in ABC when ABC is at 80. And because we're total traders, we need to know the call side and the put side. So here's a couple questions for the put side. $90 strike put with the stock at $70. $90 strike June 18th put in XYZ when XYZ is at $70, and a $70 strike June 18th put in XYZ when XYZ is at $90. That's it, team. Don't forget, join the TWR Investment Club. Check out our free chat to learn more. Traders War Room Trading University is happy to announce open registration for our next option fundamental course. Did Wall Street make you feel like a complete loser in 2022? Or was everything going great and you blinked just for a split second and got repeatedly kicked in the you-know-what over and over again? TWR is here to help you. Our university's fundamental course is an in-depth 5-week-long course that's done live via Zoom platform. Our virtual classroom is where you can interact with the instructor, other students, or see copies of the classes right there on the platform, and rivals that of traditional online education. Testimonials from previous class graduates are proof that our cradle-to-the-grave approach works in giving you consistently profitable skills to trade options. Registration is open today. Links are in the description, or go to traderswarroom.com. I will see you there. Let's go to war. Traders War Room is your one-stop shop. Try our TWR one-to-one mentoring. Does the market have you feeling like this, or wanting to rip your hair out while you watch your account dwindle? If that's you, then Traders War Room has you covered. Our one-to-ones focus on you as a trader or investor. The Zoom session connects you with a TWR professional. Whether we're covering charts, developing a plan of attack, or being strategic and deep diving on the how, why, and execution of trade plans. TWR one-to-ones will give you the confidence to attack, conquer, destroy, and make the market bend the knee in 2023. Join TWR and bow to no one. Book your session today. The link is in the description or on the website at traderswarroom.com. Let's go to war. Make the market bend the knee in 2023. Join TWR and bow to no one. The link is in the description or on the website at traderswarroom.com. Let's go to war.